All right, let's take a look at Chapter 19. Chapter 19, as you see, is financial statement analysis. It's really what we're going to do. The main focus of Chapter 19 is to understand financial statements, understand some of the numbers that come from financial statements. We're going to use those numbers, pull numbers off financial statements, and create ratios. Ratios are great because they can tell us something about the company. All right, they're relative measures of something generally, and we can get an idea as to a firm's maybe profitability, operating efficiency, liquidity, just to name a few. All right, so we start here by talking about the major financial statements. You certainly would have covered this at some stage, some class at some point in your life. We start here with the income statement. The income statement is a summary of the profitability of a firm, summarizes the profitability. Essentially, if you think about profits, what are profits? It's the difference between, the funds, the money that we've been able to generate, revenues that we've been able to generate, the difference between that and the cost incurred to generate those revenues, right? So we expend resources to generate revenues, and hopefully more comes in than went out, right? So profitability, that's what profits are. We look at again, net income. We start at the top of our net income statement, with revenues. That's the money that we generated during the operating period, and then we subtract out the expenses that we incurred during that same period, and of course the difference again is net profits. Your book talks about 4 different categories of expenses. There's cost of goods sold, right? Direct cost attributable to producing the product. There's general administrative expenses, which, typically we think about overhead expenses, salaries, advertising, things like that. Interest expense, if the firm has taken on debt, then there's typically interest expense. And then finally, there's taxes that are due to the federal government. So again, I'm going to put up here, we got revenues, less cost, come on, spell cost, less our expenses, let's say that, ultimately is going to give us profits. And then we see that our expenses can be cost of goods sold, our general and administrative expenses, potentially interest expenses if the firm has debt, and finally taxes. So these are the 4 general categories of our expenses. One thing to remember about your income statement is that your income statement is for a period of time. It's not at a point in time. So our correctly labeled income statement would say something like, for the period ended, let's say December 31, 2015, right? And what that's going to show us is that these are the revenues that came in during that time period. These are the expenses that we incurred during that time period. And the difference then is going to be our profitability during that time period. Okay. Looking at a little income statement on page 636, you can see it starts up here at the top with revenues, sales that came in, less cost of goods sold, less your selling, general administrative expenses. You can subtract out depreciation as well. Depreciation we'll probably talk about later, but it's a non-cash expense, but it is an expense. It's an accounting tool to help us allocate the cost of an asset over the period of time in which it's going to help us generate revenues. So we've got revenues minus our cost of goods sold, selling, general administrative expenses, depreciation. That's going to give us some measure of operating income. It's sometimes referred to as EBIT, but it's operating income. EBIT stands for earnings before interest and taxes. Then we subtract out our interest. That's going to give us earnings before taxes. Then we subtract out taxes, and it's going to give us earnings after taxes. We might refer to that as net income. Right? So that's a simple little income statement. Let's talk about our balance sheet. Our balance sheet is your book here talks about it being a snapshot of the financial condition of the firm at a point in time. The balance sheet lists our assets, our liabilities, and our equity. The accounting equation says that assets equal liabilities plus our equity. And if you think about it, that makes sense. Think about if you happen to own a home. If I were to ask you, about your home and how much equity do you have in your home, you'd probably say, okay, my home, let's say, is worth $400,000. Maybe that's the value of the asset, minus what you owe on it. Maybe you owe the bank $300,000. That would be your liability. So asset minus your liabilities gives you what your equity is. You would have $100,000 in equity. That's the accounting equation. Assets equal liabilities plus equity. Okay. Your balance sheet is, again, your book talks about it. They call it a snapshot. And so if you think about a camera takes a picture. Snap that picture. And right then it freezes at that moment in time the assets, the liabilities, and the equity. So that's why it's important that your balance sheet correctly be identified or labeled as of a certain date. Let's go back and look at the balance sheet. It said for the period ended. So for the period that ended December 31, all that took place. But the balance sheet may say as of December 31, 2015. And that's not the same. What we're saying here is on that date, on December 31, 2015, that's what the firm looked like. Okay, that's different than the balance sheet, right? On your balance sheet, you've got, again, assets, liabilities, and equity. So your asset side, you're going to start up at the top with the more liquid assets. So you're going to have current assets, then you're going to have your fixed assets, and your current assets and your fixed assets is going to equal your total assets. All right. On the right hand side, you're going to have your liabilities, and you start with your current liabilities, which are those liabilities that we expect to pay within a year's time. Then we're going to have our longer term debt. So that's going to give us our total debt or our total liabilities. We're going to then have our equity in addition. And so on the right hand side, we've got total liabilities plus equity. And they equal, don't they? Your assets, whatever's on this side, will equal the total of your liabilities and equity. Okay. You could also have a cash flow statement. And certainly that's important. I will say for our purposes, in terms of looking at the health of the company, trying to calculate ratios, we're going to focus primarily on the income statement and the balance sheet. But you could certainly also have a statement of cash flows. So when you think about cash flows, there can be inflows and outflows, right? Inflows and outflows. And so it's important, if you happen to be the treasurer or the CFO of a company, it's important that you understand how much is going in and how much is going out. All right. The other thing you need to know is what's the source of those funds, either the source or the uses. When we have money coming in, is it coming in because maybe it was cash provided from operations? Right? For instance, if we decreased our inventory, if we decreased our accounts receivable, then that's going to be an inflow of cash, and with that actually comes from operation. Or if there was an increase in inventories, well, that means that we spent our cash to increase inventories, and so that would be a cash outflow. So we've got cash from associated from our operations. We've got cash from investments. For instance, if maybe our fixed assets increased, well, that would be a use of our cash. Cash went out to increase our assets. Okay, perhaps we sold some of our assets. That would be an inflow from that. And finally, we've got cash from financing activities. If we sold some bonds, for instance, we issued some bonds, that's going to be money that comes in, and it was associated with financing. Perhaps we paid dividends. Well, that's going to be associated with our financing because that was from our equity capital that we had raised. So, like I said, this is a financial statement that's important, not so much because we're gleaning that much information from it for our ratios, but someone who's running the company that needs to make sure there's cash on hand to be able to pay for things, pay for wages, pay for raw materials, pay the suppliers. Statement of cash flows is hugely important. Okay. So then your textbook says, all right, let's take those financial statements. Let's see if we can pull some information from them and see if we can measure firm performance. We can look at, for instance, our investments in real assets. How are we doing? Are we making returns on the investments that we have in our assets? So we start with some profitability measures. And one of the first ratios we see is ROA, return on assets. Okay. Now, please understand that different textbooks are going to have different definitions. For instance, I've seen, well, our definition here by this textbook is EBIT divided by total assets. Total assets. All right. Actually, I guess I'll write that out for us. EBIT divided by total assets. Let's go back and look at EBIT. Here's our EBIT, operating income. That's some measure of profitability we have after taking into account how much money came in, revenues, minus depreciation, selling, general administrative expenses, and cost of goods sold. So all of our operating expenses. So our EBIT is a measure of operating income. Okay, I've seen this same measure, ROA, be defined as net income over total assets. Okay, so again, there's not just one definition of some of these ratios. Like I said, our textbook here says return on assets is the operating income return on total assets. We could also have return on capital. And this is, again, EBIT. I could see it as being net income, but EBIT divided by our long-term capital. So who is supplying long-term capital to the firm? Shareholders are, because shareholders have purchased stock and have an equity investment, and also the purchasers of our debt, of our bonds, the long-term debt. And so this is telling us what is the return to our investors, or what's the return based upon the level of long-term capital that we've been able to raise and invest in the firm. And the last ratio that they mentioned is ROE, which now we're going to go to net income. instead of EBIT, but we've got net income over shareholders' equity. Okay. We talked about ROE in the previous chapter when we were talking about how a firm can grow. Remember, we said the firm's growth rate was a function of their retention rate times the return on equity. So when the firm does invest capital, when they reinvest their earnings, the ROE, this is the rate of return that they are investing. This is the rate of return that they're earning when they're investing shareholder funds. So three different profitability measures. Now we're going to talk a little bit about financial leverage. Having trouble writing. All right, so financial leverage. Understand that concept. Financial leverage has to do with the use of debt. Okay? And when we use debt, we can actually raise our returns through the use of debt. We can raise our returns by using other people's money. We can leverage up our returns. Let me give you a simple little example here. Let's say that you purchase an asset for $100 during the time period, during the 1 year in which you bought this asset. Let's say you received, I don't know why I put a dollar sign there. Let's say you received $2 in income. And then you sold the asset for 105. What was your rate of return? Okay, well, you bought something for 100 that grew to 105, right? So you sold it for 105, you bought it for 100. You've got a $5 gain there, plus you had a $2 in income. So that gives you $7 divided by $100. It looks like to me you had a 7% return. Right? All right, let me see here just a minute. All right. Let's see, that's 5, 6, 7. All right. Let's say on the other hand, alternatively, let's go to the next page here. Alternatively, same scenario, you bought the same asset, but this time you didn't buy it for cash. Okay? Let's say that you borrowed $40. All right, you borrowed $40. And the interest rate on the borrowed money, let's say, was 5%. So how much interest would you have paid on that? $40 times 5%, what is that going to be? $2. Okay, so you're going to owe $2 in interest. So let's calculate your return. You bought something for 100 that you sold for 105. You received $2 in income. So the same thing. You had a $5 capital gain. You've got $2 of income. We need to subtract out, though, interest costs. Oh, okay. Well, and so the $2 right here, that was our $2 in income. But we're also subtracting off the $2 in interest that we incurred. And how much did we put up? Well, if the asset was $100 and we borrowed $40, that means we put up $60. So what we end up with, our return was a $5 gain on a $60 investment. That return is 8.33%. So what we just did here is a simple little example. Wasn't all that tremendous, I suppose, but on a cash basis we made 7%. On a margin basis, that's what we've done here, we borrowed part of the purchase price, we had an 8.33% return on the exact same thing, on the same investment. Okay, so the point here is that we use financial leverage. Leverage allows us to lift our returns higher than we could get on a cash basis. Well, your textbook on page 643 shows the relationship between ROE and ROA and leverage. Okay, now generally for most firms, when you compare ROE and ROA, we would expect the return on equity generally to be higher than ROA, because when you're using equity, okay, the return on our equity investment, as long as we have some debt and we've borrowed some money, then our return on equity should generally be higher than our return on assets because of the use of leverage. In fact, your textbook shows ROE equals 1 minus the tax rate times ROA plus ROA minus the interest rate, all that times your debt to equity ratio. Okay. So one of the things that we see then from this example is that, two things I suppose. Assume that there is no debt. Assume there's no debt. So look up here at this ratio. If there's no debt, then that's 0. Okay, well that's going to be a problem because you can't really divide anything by 0. But if we don't have any if we don't have any debt. No, I'm sorry, that's not right. Yeah, we can divide by 0. We just can't divide 0 into anything. So if our debt happens to be equal to 0, then we would say ROE is simply equal to ROA times 1 minus the tax rate. Alternatively, they also point out if your ROA and your interest rate are the same, this is going to hold as well. ROE will equal your ROA times 1 minus the tax rate. So this shows us that typically ROE is going to be higher than ROA. Your book also talks about another term called economic value added, EVA. Economic value added is another measure of profitability and of return. Okay, so we say that ROA, your book says ROA, return on capital, ROE, it said all of those are pretty commonly used to measure performance. Okay, but that the firm should also consider how much value has been added to the firm. And they say economic value added is the spread between our return on capital and our cost of capital that we talked about earlier, multiplied by the amount of capital in the firm. All right. So, what does that mean? Well, let's put some numbers in here In fact, we see that you've got a great example with Intel. They tell us that the firm's return on capital was equal to 13.9%. So when you look at what was the return, right up here, ROC, return on capital, EBIT divided by all the long-term capital, the operating income relative to the long-term debt and the shareholders' equity, 13.9%. Okay. We were also told that the cost of capital, which is equal to K, was 7.8. So what that means is that it cost the firm on average 7.8% to raise every dollar of long-term capital. Whether it was long-term debt, whether it was stock, it cost them on average 7.8%. But the return on their invested capital was 13.9. So the difference, 0.139 minus 0.078, is how much they benefited for every dollar of capital. And since they had a capital base, Intel does, of $56.34 billion, this is how much value was added to the firm. Because it only cost them 7.8, they made 13.9 per dollar of investment, and that's how much they invested. A simple way to look at this, folks, would be if you went to the bank to borrow money, and the bank is going to charge you 8%. And you invest that money and you're able to make 11% on every dollar. That's 3% that you're going to make on every dollar. And let's say you borrowed $1 million. Then you would make 3% on $1 million. You'd make $30,000 of profit. Or not profit, rather. That's how much would have been value added to the firm because of your efforts. So that's all economic value is. It's the difference between what you can earn and did earn on your capital versus what you paid to raise your capital times the amount of capital that you raised. All right. Okay, so the next thing I want to share with you is something called the decomposition of ROE. This was made famous by the DuPont Chemical Company, all right, where they take ROE. We already know what let me write it up here. ROE, remember, is equal to net income over equity. That's the return on equity, all right? Well, we're going to break this down into 5 different components. So I'm going to write it this way. Return on equity equals earnings after taxes another name for that is net income. Okay, earnings after taxes divided by earnings before taxes. Give me just a moment. Go back to our income statement. Here's earnings after taxes. Here's earnings before taxes. Here's earnings before interest and taxes. So we're using each one of those. Earnings after taxes divided by earnings before taxes times earnings before taxes over earnings before interest and taxes times earnings before interest and taxes divided by sales times sales over total assets times total assets over equity. All right. Well, I know you remember this, but if you, as we're multiplying these ratios, if you'll notice, that's going to cancel, and those are going to cancel, and that's going to cancel, and that's going to cancel. So we're going to be left with earnings after taxes over equity, which is net income over equity. Okay? So clearly this is not a shortcut to arriving at our return on equity. Rather, what we're doing is we're taking a ratio, ROE, and we're breaking it down into all these different components. I want you to look at this first term right here. The only difference between the numerator and the denominator is what? earnings after taxes, and earnings before taxes? And the answer is taxes. So this is referred to as the tax burden. Let's look at the next one. Number 2, what's the only difference between the numerator and the denominator? And the answer is interest. This is called the interest burden. The next thing we see here is EBIT over sales. All right, this is referred to, and let's go back and look at that. EBIT, which is right here, and here's sales, which is up here at the top, revenue, same as sales. Okay, so this is basically a return. It's an operating income over sales, and it is the return on sales. It's a type of profit margin. It's an operating profit margin. Or also what's called a return on sales. The next one, number 4, sales over total assets. That's called our total asset. Different names for it. Your book calls it the total asset turnover. I don't like to call it that. I like to call it the total asset utilization ratio. You can call it total asset turnover if you want. I don't think the firm turns over all their assets every year. I think what this tells me is how the firm is utilizing their total assets to generate sales. Okay? And then the last thing that we see here is really our leverage factor. Okay? It's our leverage factor. Sometimes we call it an equity multiplier. Well, what are we trying to accomplish here? We're trying to break down our return on equity into different components. What if I had asked you to evaluate this firm over the last few years? And what you noticed is that the return on equity, which is something that's very, very, very important, the return on equity has been declining. It has been systematically declining over the last few years. Well, why? And so you go look at the ratio and you go, well, let's see. There's something going on here with net income or equity. Well, that doesn't help me very much. So ROE can be broken down into these 5 components, and now we're maybe able to, what if we were to run each one of these ratios, calculate each of these ratios over the last several years? We could see if maybe is the tax burden changing. So if there was something associated with the tax burden, it would probably be something, obviously the only difference between numerator and denominator is taxes. Maybe our taxes went up. Maybe we had some tax credits in the past, and all those tax credits have expired, and so now as a result our tax burden has increased. We're paying more in taxes than we used to. Maybe it's not that one. Let's look at ratio 2. What if ratio 2 has declined? Well, it could have something to do with our interest, right? Maybe our interest cost has increased. Maybe we had a fixed type of financing, a fixed interest rate, and now we've gone to a variable rate and interest rates have risen. Right? Let's look at statement number 3, ratio 3. That's our operating profit margin, our return on sales. And so maybe that's the one that's lagging. Well, if that's lagging, I think what we need to do, we need to look at the expenses. We need to look at our operating expenses. Let's see. Maybe it's a depreciation thing. Maybe we had purchased another asset and increased our depreciation expense. So maybe there's nothing really to worry about. Maybe our selling and general administrative expenses have increased, or our cost of goods sold have increased. Let's take a look at, maybe that one's fine. Let's look at ratio number 4. That's our total asset utilization ratio. We don't have it here, but what you'll see is we actually can break this one down a little bit. Let's see where I can find that. On page 649. if we wanted to, we could break this down into sales over our fixed assets. We could see if it is in fact ratio number 4 that's lagging. When you think about your total assets equal your fixed assets and your current assets. So we could break it down and look, okay, let's look at our fixed asset side. Or perhaps if it's not one of those, it could be our current assets. We could look at our inventory turnover, which is cost of goods sold over inventory. Perhaps it is related to our accounts receivable. Accounts receivable divided by sales. Actually, it's average accounts receivable over to sales times 365. But the point is that what we can do is, if it's ratio number 4 that is lagging, we can try to figure out why is our asset utilization ratio lagging. I want to give you that interpretation over here. Sales over total assets. Let's say that happens to be 5. I'm just throwing out a number. My interpretation would be for every $1 you have invested in total assets, you're generating $5 in sales. Same for your fixed assets, sales over fixed assets. If let's say this is 3, for every $1 you have invested in fixed assets, you're generating $3 in sales. So that's how I would interpret ratio number 4. Finally, we have ratio number 5, which is our leverage ratio. Okay, so my point is that we can take one ratio, our return on equity, and we could break it down into at least 5, maybe even more ratios. So if our ROE is lagging, now it gives us a place to go look. Okay, we can try to understand perhaps why our ratio is lagging. Let's see here. What do you think you get if you multiply ratios 1 times 2 times 3 times 4? What are you going to get? Well, it looks like you're going to end up with net income over total assets, which is another type of measure of return on assets. I know our return on asset number was actually EBIT, I think, over total assets. But this gives us an idea of how much net income we've generated relative to all of the assets that we have in the firm. So continuing with our discussion here, okay, let's take a look at some liquidity ratios. These are in addition to the ones that we've already seen. I mean, we've already talked about some efficiency ratios, asset management ratios, like sales over total assets, sales over fixed assets, cost of goods sold over inventory, and so forth. Liquidity ratios. The first one we see here is the current ratio. Current ratio is current assets over current liabilities. You know, current assets are the assets that are cash or we expect to convert to cash within a year's time. Current liabilities are the liabilities that we owe within a year's time. The example in the textbook looks like for this firm, they've gone from 1.46 to 1.17 to 0.97. And the industry average is 2. So that's what the industry is. So is this good or bad? It's not good, because look, with this being at 0.97, that means for every $1 you're going to owe this year, you've only got 97 cents in your current assets to cover that. So we've really got a liquidity issue that we're facing, especially since we're half as much as the industry. Okay? So we need to look at something. There's something going on here. Another ratio is the quick ratio. It's current assets minus, well, okay, yours has it different, but I'll write it two different ways. Current assets minus inventories divided by current liabilities. Your book writes it this way. They say cash plus marketable securities plus receivables divided by current liabilities, which is the same thing because current assets equals cash, marketable securities, inventories, and receivables. So really all we're doing is subtracting out the inventories, and the reason we do that is the inventories are the least liquid. So this quick ratio is really probably a truer measure of true liquidity. Now if you'll look, this firm went from 0.73 to 0.58 to 0.49, and the industry average is 1. Okay, so once again, I think our trend is troublesome, isn't it? Our trend is troublesome. If you'll notice, the current ratio went down and the quick ratio went down. Well, we might have thought by looking at the current ratio that, oh, you know what, it's probably inventory. Maybe we've been buying a lot of inventory and that's what's driving it down. No, I guess we're not buying a lot of inventory, but maybe it's inventory related. It doesn't appear to be inventory related because when we look at the quick ratio went down and it doesn't include inventory. So we need to look pretty closely at how much cash we have, the marketable securities, receivables, and see what's happening there. We can also look at our cash ratio. And our cash ratio is just cash plus your marketable securities divided by current liabilities. Okay, and we see it's going from 0.487 to 0.389 to 0.324, and again that lags the industry pretty significantly. Okay, so as we break this down here, I'm inclined to say, we need to look at our cash position, okay? Because it looks like when we break out all of these things, we start with all of our current assets, and then all of our current assets except inventory, and then finally we've just got cash that we're looking at, cash and marketable securities. That may in fact be our issue. Okay. I see a couple of other ratios here that we talked about in a previous chapter. Market to book. The market to book ratio. We talked about that. I think we did. No, maybe we did price to book. Okay. So this is the market price per share. No, that's the same thing. Yeah, price to book, and we talked about that. So this gives us an idea of how much investors are currently willing to pay for the equity, right? Because that's what book value is. It is equity per share. It's kind of like it's a benchmark. It's a multiple. Below that, we see the price earnings ratio. Okay, so this was the price to book that we talked about earlier. This is the price to earnings. The PE ratio tells us how much an investor is willing to pay for $1 of earnings. Generally speaking, the higher the PE ratio, the more optimistic the firm is about, or investors are about the firm's ability to generate additional capital. Couple things also that your book talks about when you're pulling numbers off of your financial statements. When you're pulling money, for instance, or pulling numbers, maybe there's a ratio like sales over total assets. See, the sales number comes from the income statement. The total assets, if you remember, total assets comes from the balance sheet. And so your textbook said that sometimes when you're pulling money from two different values from different financial statements, it's common practice when you're pulling a balance sheet item is that you take the average of the beginning and the end of year balance sheet items. So for instance, if we were pulling, if we wanted total assets, for instance, we would take total assets at the beginning of the year plus total assets at the end of the year and divide by 2. Remember that your balance sheet represents some value at a point in time, and it may be that at the end of the year the values are systematically, they're always high at the end of the year and low at the beginning of the year. Okay, so depending upon when you would actually pull the number off the balance sheet, you may be overestimating or underestimating the true picture. And so the general convention is to average the balance sheet items. Take the beginning of the year plus the end of the year and divide by 2. That's what we do with the balance sheet. On page 654, you're going to see several different financial statements, or rather financial ratios. You've got leverage ratios such as the interest burden. You've got asset utilization ratios. We talked about a few of these. We've got the liquidity ratios, profitability ratios, and some market price ratios. I think probably what I don't know how we'll test it. My guess is going to be that I'm going to give you a financial statement, balance sheet, income statements. I'm going to probably ask you to calculate some ratios. What we will probably find when you calculate some ratios is that maybe some of the ratios have declined in value or increased in value, and so I'm going to ask you to comment on what seems to be driving those changes. For instance, if like ROE, if ROE was declining significantly, I might ask you, explain why, help me understand why my ROE is declining, or perhaps my ROE is increasing. And I'd ask you for a pretty good explanation on why the ROE has, the performance has improved over the past few years. The last thing that I'm going to say from this chapter is that we're pulling numbers off income statements and balance sheet, and it is helpful, but there are sometimes we face some comparability problems. I just gave you an example of one. I mean, the fact that balance sheet items, it's at a point in time. So if you were to do the analysis in June, you might get a totally different answer than if you did the analysis in December. All right? And so that's why it makes sense that you wouldn't use just one number off the balance sheet, but maybe you average some numbers off the balance sheet. So that's one issue. Another issue is inventory valuation. So inventory valuation. Some firms may use the FIFO method. The first in is the first out. Other firms may use a LIFO method, last in, first out. There may be someone who uses an average or a weighted average approach. Okay, and so if you are trying to make some comparisons in different firms, and different firms may have used different accounting methods, then it makes comparison more difficult. Another potential problem has to do with depreciation. There's more than one type of depreciation method, right? You can use an accelerated method, you could use a straight line method. So depreciation comparability problems are kind of significant. People use, or firms often use an accelerated depreciation method for tax purposes, and then straight line depreciation for published financial statements. So therein is another one. And finally, I think they talk about inflation. A couple of issues. One is with inflation and also interest expense. No doubt inflation causes some changes or distortions. fact, your book cites that it can cause distortions in the measurement of a firm's inventory and depreciation. It says, but it probably has a much greater effect on the calculation of the real interest expense. So it's, again, inflation can change things. It makes comparison across firms and across time very, very, very difficult. So for this chapter, I want you to understand the basics of your financial statements. I want you to understand the ratios. Be prepared to calculate and interpret all of these different ratios that are listed in this chapter. Your book does, I think, a really good job of walking you through each one of those ratios. Be able to dissect some financial statements that I might give you, and do a ratio analysis, and then be able to comment on the firm with respect to its liquidity, its leverage, its profitability, and so forth. That's going to do it.